percent to 1,260 crore rupees approximately versus estimation of around 1,000 crore rupees. So huge beat on all the three numbers from the Tech Mahindra. Remember that Tech Mahindra is under the new management, so we can say that this is a positive start under the legacy of the new management. But talking about the new deal wins, well, the second quarter net new deal wins came in at about $603 million versus around $534 million. So the TCV deal wins have also been up about 13% on a quarter-on-quarter basis. Well, apart from the numbers, the company has also declared a 15 rupee dividend for its shareholders. But what is important for Tech Mahindra is the communications vertical, which contributes about 33% of the company's revenue. Well, this vertical grew about 3% on a quarter-on-quarter basis. Now, remember that this was one of the things to be watched out for in Tech Mahindra, and this came in at a healthy number. So, not a disappointment is what I believe. But then, let's talk to Mr. Rahul Jain, the Director Research at Dolat Capital. Hello and welcome to the show, Mr. Jain. What are your first take on the Tech Mahindra numbers?
Yeah, hi, thanks. So we like the number per se. From a revenue point of view, I would say it's more like inline result. From a profitability point of view, the improvement is slightly better than what we were anticipating. So that's a positive thing. There is some improvement on the TCV front as well, but to go out there. So it's a good number, but miles to go is what I would say.
What is your take on the communications vertical? Because this is what was under pressure since last couple of quarters, and when the management said that they do see weakness in the communications vertical in the press conference, this seems that there's a little way to go before the communications vertical revives. So what are your thoughts on this one?
Yeah, I think it's been a challenge for quite some time, and there could be a quarterly movement that may happen, positive or negative. It would be too premature to talk about whether this is a directional change on that thought process. But yes, any positive movement is generally taken in that context. If you look at the recent history, we saw couple of very weak quarter from the vertical. So from that point of view, where we are today is still significantly lower number even on a YOY basis. So once we need to recoup the past run rate, and then we would be in situation to think about whether it's going to be a growth contributor going forward.
Okay, so if not the communications vertical, which vertical do you think will drive the growth for the company?
I mean, this quarter, apart from communication, there are a couple of verticals where we saw good growth, including the technology vertical as well as retail transport vertical and the others vertical. So I think the performance is pretty round. Communication recovering back to growth is definitely a positive thing, and of course there are more segment that is contributing well.
Right, got it. Okay, let's talk about the most loved topic of IT investors is the discretionary spending. Well, this has been under pressure since a couple of times. Same old story for all the companies, wherein they are saying that discretionary spending is still conservative by the client. But some of the companies like Infosys also mentioned that there is slight bit of pickup over here. So what's your take on the basis of what management are talking to you?
Yeah, I think what they speak on the call is what we also hear from them when we talk. I think there is some weakness, and it is very much visible from the TCV win. If you see across the board, there's this 5-6 results that have come, and everywhere one thing that we have seen common is that TCV growth has been pretty muted for the sector. So that is very well articulating the fact that there is a cut in spend. However, in some pocket, what we have observed is that in the past, when there was a good TCV win, but the revenue conversion was slow because deals were not ramping up, there are few management who are talking that now those deals are taking shape. So there is some bit of unexecuted part of the past orders which is supporting the momentum. I think that is something to support for now, but TCV pickup should happen for the sector to go back to high single-digit growth, which it used to do on a consistent basis in the past.
Got it. Okay. The new management had chalked out the 3-year plan for the company. What are your takes? Will they be able to achieve the 15% margin that the management had called out for? And do you think that would happen in the next 3 years?
Yeah, I mean, it's an ambitious goal that way because given where they are right now at 9.5%, and the industry factors are also not very conducive. So I would be far more positive about this journey if this was taking shape in a very good environment, because with much higher growth rate, building that operating leverage is quite a possibility. But when the market is tough, deal making is tough, your ability to get the right pricing on the deal itself is a challenge. So generally this kind of market are headwind for the profitability, and you just can do through efficiency gain. So there is some efficiency led gains that can come, and they are also very careful about the kind of portfolio they are picking up. So it will improve the margin profile, I think, but 15% still look a tall ask for me. I don't think it's possible within the 3-year time frame. If they do it, that would be a credible achievement.
Okay. Coming to the point, your take on Tech Mahindra, I reckon that after the Q1 result, you had maintained a sell rating and a downside of about 15% on the stock. So what are your key triggers that you look forward to at Tech Mahindra, which will make you change your rating to a sell and upgrade it to a further rating?
I mean, valuation calls are generally function of the kind of estimate that you have and the kind of earnings multiple that you would be comfortable given the growth or margin profile of the business. If you see what we have generally observed in this market is that on very slight hope, there is a significant amount of momentum that generally the stock sees. So at this point, on our assumptions, the stock is already trading on 25 times on FY27 number, and the valuation, even from a FY26 perspective, which is a more right benchmark at this point, it is at 29 times. So even assuming significant improvement in growth and profitability, we are for taking that much risk in our estimate. The valuation are still not reasonable. So that is the reason we have a sell view. Of course, if the commentary improves on the growth side, then the confidence will improve on their ability to deliver. For that, lead indicator like TCV and hiring should be a key data point. This quarter, they have shown 4% growth in the headcount, which is a positive sign. We would hear what they want to say about this and eventual TCV pipeline kind of a thing before we may turn in a different view on the stock.
Right, Ms. Jain, thank you so much for that, for those responses. We'll move on and turn the focus on to some of the banking results that have come out already, specifically Kotak Mahindra Bank and RBL. So, but I want to talk to Rahul Malani of Sharekhan BNP Paribas. Rahul, specifically on the Kotak numbers, now there's a 4.8% rise in net profit on a year-on-year basis. You think that a lot of this has to do with what the RBI has done with Kotak?
Yeah, good afternoon firstly. So overall, yes, the performance is weak, led by the some of the headwinds in the sector, and along with the reason you alluded regarding the embargo with the RBI relating to the onboarding of new customers through digital channels and sanctioning new credit cards. numbers are weak, but on expected lines. However, a negative surprise has come from the asset quality. Slippages are higher than expectations by around 10% higher than our expectation number. That is why it has in turn, which has led to higher credit costs around 10 basis points sequentially quarter on quarter. NIM compression was also higher than expected, led by which is an industry phenomena. But however, we were expecting around 5 to 7 basis point compressions, but NIMs have declined by around 11 basis points. However, the NII is in line with our estimates and consensus because it has been managed by higher interest income from investments. So overall, on the positive side, in the results, the only point which I saw is that CASA growth has picked up, led by saving accounts deposits, which has shown an impressive growth of 5% quarter on quarter. So yeah.
I want to talk to you a little bit about the asset quality front. You mentioned that there has been some higher than expected slippages. One would assume that this has to do with the credit card portfolio, considering that growth there is a bit of a problem. Even though year on year the portfolio has grown about 15%, quarter on quarter has actually come down. So probably why you're seeing higher slippages?
So basically, our looking at the initial numbers, we believe that higher slippages would have come from the microfinance segment, firstly. Secondly, on the credit cards book as well as the personal loans book, which is where the industry is facing stress due to over leveraging of the segment. Thirdly, we believe that some of the slippages would have come from agri segment because the agri book has declined by around 1% sequentially in quarter on quarter. And some of the slippages from the SME, from the commercial banking.
Right. Rahul, just hold on for a second. HDFC Bank numbers are out and they're up on your screen right now. Net profit is about 16,820 odd crore, slightly higher than what was expected from analysts. Asset quality front, there's been a little bit of a marginal disappointment, 3 basis points higher quarter on quarter. Similarly, on the net NPA as well, you're seeing 0.41% compared to 0.39 QOQ. I don't know how much time you've had to take a look at this, Rahul, honestly, but the profit number, is that looking as per your expectations for HDFC Bank?
So basically, numbers are broadly marginal higher than estimates on the bottom line front. At the operating profit level, we believe that the numbers are broadly in line, and asset quality will continue to remain range bound and range bound in the current scenario. Clearly, the focus of the management here is to strengthen the balance sheet over the year, and with course of correction by increasing the normalizing the CD ratio by increasing the deposit mobilization, and currently focus would be on rather than providing steady returns rather than chasing growth.
Just to get a sense of this news report, which of course we also broke on our channel about HDFC Bank looking to offload a large quantity of loans from its portfolio and move it on to bring down that CD ratio from over 100% where it is right now. But what's your view? Do you think that this is probably the best way that the bank can control its credit deposit ratio?
Yeah, I think so. That in a broad period way, earlier they had cited a period of around 15 to 18 months, but because their CD ratio is hovering above 100%. But apart from that, higher deposit mobilization plus higher rundown of the loan book will result in faster normalization of the CD ratio, which could be seen as a positive because once this normalization happens, it will be able to catch up the growth which it is lagging versus the peers.
We also have Aditya Shah, please advisors. Aditya, welcome. I just wanted to get a sense. Kotak Mahindra Bank and HDFC Bank both showing about 5% year-on-year growth on the net profit front. Asset quality has not really improved as much in Kotak Mahindra Bank's case, so it has actually gone down. I wanted to get your first sort of viewpoint on both these results.
So, Vishy, if anybody was following these banks closely,
I don't think that materially these numbers have any impact on what the stock is going to do per se. Let's first talk about Kotak. The bigger, more important point for Kotak is the embargo that RBI has put on them, and the management clearly needs to update investors on what they are doing, what are the steps that they are taking, and how they are talking to the regulator about getting the 811 back active and the credit card issuances back on. So I think the numbers are stable. There's nothing market moving per se for the company. But the update from the management, that is really very important. And also the outlook on the new acquisition of the Standard Chartered good loan book that they have done. So what was the rationale and what does the management think about future acquisitions as well? Those are the two things that I will be watching out on Kotak for. Numbers per se are okay. There's nothing to complain about as such on numbers. Asset quality, of course, Kotak was growing very fast on the microfinance side of things over the last 1.5 years. And since the microfinance cycle has already turned, you are bound to see some bit of slippages coming about. So that needs to be clearly understood from the management. So net, not surprised or not enthused about the numbers. We'll wait for the management to speak on Kotak. On HDFC Bank, again, those numbers, hardly any meaning of those numbers per se. The recovery of the margin seems to be the most important point now. We've already seen that the advances growth has come at about 7%, which means the management is consciously taking a call to lower down the loan-to-deposit ratio. That is one aspect of the merger that is being taken care of. Now, how fast the margins can really recover, I've not seen the margin number this time around. That will then depend on how the stock price continues to behave. So for Kotak, the RBI embargo, for HDFC Bank, the margin recovery are the two single most important factors that need to be understood in these results. For both the companies, the results seem to be okay. There's nothing market moving per se for the market to say anything on the results out.
Rahul, if you're still around, I just want to get your view as well on the Standard Chartered announcement that happened last evening. Kotak Mahindra Bank said that they're buying 4,000 odd crore of the unsecured personal loans from Standard Chartered. Considering the state of unsecured loans and the aversion from unsecured loans that banks seem to have right now after the RBI's commentary on it, do you think that this is probably timing was an issue, or was that okay in your view?
Basically, in this, you have to see the customer segment where the book stands currently of the Standard Chartered book. Because primarily the stress is in the lower ticket size, less than 2 lakh rupees personal loans and credit cards, where over leveraging has been seen. As far as to the best of my knowledge is concerned, the Standard Chartered book, personal book consists of high mass affluent customers, mainly from large private institutions as well as MNCs. But at the same time, rationale would love to listen to the rationale from the management upon that.
Right, Rahul and Aditya, hold on. We've got Ashutosh Mishra of Ashika Broking as well, who's joining us on the phone line. Mr. Mishra, your viewpoint on what these two sort of large, Kotak is not in the same league as HDFC Bank, but large private banks reporting results, net profit growth of about 5% on both sides, asset quality not looking in very exciting, honestly. Overall, Kotak results do seem a little weak, even on the net interest margin front. What are your first views?
Yeah, so the results are quite weak if you look from initial perspective out there, and this was expected also. Even on the NII front, we are expecting the things may continue to remain painful for the banks, because many of these banks have linked their existing loan to the EBLR and basically repo rate. And in that case, once we are now on the verge where we may see RBI start cutting the rate, in that scenario, probably the bad results may continue for a few more quarters for few of these banks.
Coming to the NII front for HDFC Bank specifically, there's a 10% rise on the net interest income despite the slower loan growth during the quarter. I'm curious to understand, does that still look bad to you?
Yes. So especially HDFC Bank is slightly different on the NII front compared to the existing bank. What has happened with the HDFC Bank is that they have taken over the HDFC Limited portfolio, which was not linked to the EBLR. It was linked to the mainly PLR of the HDFC Limited. And when the normally bank realized in the last 9 months or 12-month period out there that once the rate hike scenario is behind us and down the line we will be going to see the rate cut and how to position your portfolio. So HDFC Bank was relatively safer and planned it much better compared to other large private sector banks out on this front, and that's why they are relatively better positioned to deal with this scenario because of the merger.
Aditya, I wanted to get your view in as well. What levers remain for HDFC Bank now that the loan growth is going to be a little slower? You talked about margin management being the most important topic as far as investors in HDFC Bank are concerned. How can the bank do that at a time when the RBI is clearly indicating there is no rate cut coming very time soon?
So there are a couple of levers that HDFC Bank has got, and it is really using it. First of all, is the refinancing of the HDFC bond book that it is already going on, and that is already an ongoing process. The second of all is increasing the mix of retail loans versus the corporate loans. That is also in progress. Third of all is increasing the level of retail deposits as compared to corporate deposits. So all of those phenomena are already playing out. The company is trying to focus on margins, focus on getting back to the LDR ratio at where it was a couple of years ago. So net analyzing NII or the asset quality right now at this stage for HDFC Bank will be a futile exercise. Of course, the asset quality is in line. We've seen asset quality across several sectors within the financial services space deteriorate. But for me, at the moment, we can pride on HDFC Bank holding on to its asset quality. But there are bigger fishes to fry for HDFC Bank. The levers will be in place. We need to look at the management. If the management guides that the margin recovery will take place within the next 2 to 4 quarters, I don't believe that the stock price is going to hang about here. That's the only thing that we are waiting for from HDFC Bank. So the guidance per se from the management over the call will be the most important thing for HDFC Bank now.
Rahul, your views on what potentially could work for HDFC Bank in the coming quarters? This quarter seems pretty not so bad but not so great results.
So basically, if it continues at least for the next 2 to 3 quarters, sustained growth above 1 lakh crore accretion in the net deposits, it will lead to faster normalization of the deposit growth, which will help it to come back on the growth trajectory. Apart from that, the bank is also engaging in running down its the loan book. So we believe that in the next 3 to 4 quarters, if the CD ratio normalizes, then automatically things will progress. Secondly, on the NIMS front, as the wholesale borrowings of the higher cost of borrowings from the erstwhile HDFC Limited gets repaid in next 2 to 3 quarters, the cost of NIMS would get support from the low cost deposits. And apart from that, gradually recouping the CASA will also support the NIMS.
Right. Ashutosh, your viewpoint going ahead. Now, I want to also bring in, Ashutosh, for you, RBL Bank, which was the other bank that announced its results for the second quarter, and the numbers don't seem to be good at all, especially on the microfinance front. They have highlighted some stress that's coming through. How are you reading those numbers?
So yes, RBL Bank number was quite disappointing, and we all were hearing that microfinance portfolio across the sector is not doing well. Credit Access Grameen has already downgraded issued a cautious statement on the microfinance part of it. So yes, that portfolio is under stress across the lenders out there, and we have seen in the RBL Bank results that some negative impact is flowing out there. We need to watch out how that performs, because going forward from here, monsoon is quite good. Rural spending is also picking it up, and from that angle, things may improve going forward from here. So it will be important to listen from the management how they are seeing this portfolio doing over the next 6-month period from here.
To your mind, for RBL outside of the microfinance portfolio, what seems to be working at this point in time?
So for RBL, yes, there are credit card is another large segment where they are doing, they have a good stake, and how that part of the portfolio is doing, especially unsecured portfolio, is also not doing great. Like if you look, Axis Bank has also given cautious statement on unsecured portfolio, and their NPA was majorly flowed from the unsecured loan portfolio out there. So we need to look how this part, especially in the case of RBL, where they have one part, MFI, which is not doing good. Another large portfolio or profitable portfolio which they have is unsecured credit card portfolio. So how they are going to manage and balance these two parts will be very important to watch out for.
Aditya, your view on RBL's numbers, microfinance being a pain point is not entirely new. I mean, RBL itself has gone through the cycle before. But to your mind, any issues that you're seeing?
So, RBL Bank was a bank that always focused on the unsecured side of the book very aggressively, be it credit cards in the microfinance space. And we are seeing the microfinance cycle really turning down, and every micro lender is facing huge asset quality issues. So my perspective is it's time to stay away from micro lenders for the time being. The micro cycle needs to be seen how it plays out over the period of next 2 to 4 quarters, and then take a call. RBL Bank has embarked on trying to build up a secured book as well, but at the moment the unsecured book dominates over the secured book, and because of that and the cycle turning around, times are difficult for RBL Bank. So in my opinion, the results are not great. The micro cycle will take time to turn around, and that together with the commentary within the rural sector, it doesn't bode well for RBL Bank. So I will be very cautious on RBL Bank as of now.
Just to get your view also on banks that specifically focus on these kind of unsecured portfolios. At a time when the regulators sort of pointing out that there is some problem brewing, even if it is at the lower end of this market, but the problems are brewing and they are raising caution. Do you think as a bank, their strategy now to go into SME, which is what the management has been talking about for the last few months now, that they'll move towards SME, they will move towards home loans or more secured assets, it couldn't have come later than this now? Probably this is the last that they could actually make this turnaround.
Yeah. So from my perspective, whenever a bank tries to build a secured book, it takes about 5-7 years for them to build a good secured book per se. So I think RBI pushing out Peshwari Rahuja out of RBL Bank was exactly this point, that RBI said that unsecured book was a big part of the bank and it was building up too much risk. Now exactly RBI's fears will play out over the period of next 2 to 4 quarters as the micro cycle keeps turning down, and they will have a lot of slippages. Mind you, the best of best micro lenders are facing a lot of heat in terms of collection, in terms of NPAs, and in terms of their DPDs past 60 days and past 90 days. So my perspective is RBL Bank will take time to build a secured book. It's a long road ahead for them for about 3 to 4, 5 years. But right now at this stage, the results will not be very pretty per se. Investors need to be very, very careful on the stock, not only RBL Bank stock, but all those banks who are particularly exposed to the micro side of it. Companies like Ujjivan, companies like Bandhan, companies to some extent companies like Equitas. You need to be very careful on all of these lenders.
Okay. Okay. All right. Aditya Shah, Rahul Malani and Ashutosh Mishra, thank you so much, gentlemen, for joining us in the afternoon and talking to us about all of these bank results that have come out this Saturday. So that was Kotak Mahindra Bank, HDFC Bank and RBL Bank results discussed by some of the experts that we've put together. Bank results not looking very exciting, honestly. RBL Bank actually looking fairly weak. Even Kotak Mahindra Bank's results absolutely below performance. But let's see what the rest of the result season brings us. We've had most of the large private banks done. We've still got IndusInd and ICICI Bank pending, which will come out over the course of this week and end of the next week. With that, of course, that's a wrap on the banking results. But we've got a breaking story coming in on NDTV Profit. My colleague Shrimi from New Delhi brings us the story about the group of ministers who are discussing how to levy GST on life insurance and health insurance products. Shrimi, tell us what your sources are telling us about the meeting that happened today.
Yeah, so this group of ministers nominated by GST Council on life and health insurance has discussed today how to go about it and whether to reduce it to 5%, which currently attract 18%. So what the discussion is that they have discussed 4 options, including the full exemption of all health premium and reinsurance, and they also sort of discussed that whether the life insurance premium will be also get full exemption from GST at this point of time. But states like 6-member panel, which also include West Bengal, Kerala, Tamil Nadu. So Tamil Nadu particularly pitches for to have a full exemption, and on health insurance they are saying that it should reduce to 5% with or without ITCs. Also they deliberated upon. What we are also picking up from our sources is that the complete report needs to be submitted to GST Council by end of this month. So they have sort of pitches for that you should give full exemption to health insurance, and as far as life insurance is concerned, they're also seeking the full exemption there. Yeah, back to you.
Just for a clarification, Shrimi, so that our viewers know, the decision making is still with the council, and the group of ministers can make a recommendation. Is that right? Yeah,
absolutely. The GST Council nominate GOM to study the things and the rate implication and revenue implication, and the final call will be taken by the council, who is expected to meet in the November. All
right, Shrimi, thank you so much for bringing us that story. That was an NDTV Profit exclusive talking about what the group of ministers nominated by the GST Council is thinking as far as life and health insurance GST is concerned. That's a wrap on the show for now. Thank you so much for joining us on NDTV Profit. Stay tuned.